Hello there. I'm Andy Mardok, CFP, founder and financial planner at Vivify Planning. If you have company stock, you're probably thinking to yourself, should I be doing anything with these shares by the end of the year? In this video, I'm going to walk you through the 6-step process I take clients on as we make that decision each year. Now, of course, this is not intended as investment, tax, or legal advice because I don't know your situation. Rather, I hope this is educational and provides you with ideas as you consider how to make this decision for yourself. Step 1, estimate taxable income for 2021. There are 2 subpoints to this. I'll call them 1A and 1B. 1A, aggregate all of the income you expect to earn in 2021. This is going to be things like wages or W-2 income, net income from a side hustle, bonuses, vested restricted stock or restricted stock units, that sort of thing. If it was income during the year, be sure to include it in that number, as well as any investment income you made and recognized this year. Step 1B, subtract deductions. These are things like 401k contributions, health insurance premiums, certainly itemized deductions or the standard deduction, depending on what you take in any given year. Now, once you have subtracted those deductions, you're left with your taxable income. Of course, I am oversimplifying how this calculation works, but I'm trying to provide an overarching view so you can understand how taxable income is calculated and then applied in steps 2 and so on. So, step 2. Identify your marginal tax bracket for 2021. In the United States, we have something called a progressive tax system. What that means is as your income grows, the percentage of the next dollar you earn is taxed at a higher rate. I don't know about you, but I always find it easier to see what I'm trying to understand. So let me share with you the tax brackets for a couple filing a joint return in 2021. Now, imagine a couple has $20,000 of taxable income. That would be taxed at overwhelmingly 10%. Now, let's imagine the same couple has $80,000 of taxable income. The first approximately $20,000 will be taxed at 10%. And the next $60,000, again, approximately, would be taxed at 12%. Now, let's imagine a couple that has $250,000 of taxable income. They are going to be in the 24% marginal bracket. For the next dollar they earn, they'll be taxed at 24% federally, plus any state taxes that apply. Now, this is important because it's the tax rate at which you will pay from exercising any non-qualified stock options, exercising stock appreciation rights, selling restricted stock units or restricted stock prior to a 1-year holding period. Any of those things will be taxed as ordinary income. Once you have identified your marginal income tax rate in step 2, step 3 is to approximate which bracket you expect to be in for 2022. Now, the reason for this is while you may choose to fill up your tax buckets for 2021, if your income is expected to be quite different next year, you may or may not take any action. So walk through the same process, but using your expectations for income, bonuses, restricted stock vesting, side hustle, you name it, and expenses that you anticipate in 2022. Step 4, when you're looking at these brackets, identify the wiggle room available to you. So let me again give you an example. Our couple with $250,000 of income is in the 24% bracket that ends at just under $330,000 of taxable income. Now, what that means is they could exercise non-qualified stock options up to about $80,000 and not break through to the 32% bracket. Stated more simply, federally, all of that gain would be taxed at 24%. This is the wiggle room available to our fictitious couple to utilize their tax bracket in current years. Now, why might this be so important? What if they don't do anything and then they wait to a future year where they have $250,000 or $500,000 of gains in non-qualified stock options? All of a sudden, if that stock option is going to expire, they have to recognize the gain. And instead of it being taxed at 24%, they could be at 35. That's an 11% difference that you never recover. So efficient tax planning, utilizing brackets in the current year and in future tax years is the goal. What we're trying to do is, again, efficiently get access to the gain on company stock that you've earned by doing your work for the company. As the saying goes, it only matters what you keep. And so creating a proactive plan along the way over years and years can make an incredible difference in the value that you ultimately receive. So to summarize step 4, determine how much wiggle room you expect is available to you in 2021. Step 5, then it's time to decide. So with the example of non-qualified stock options, those are taxed as ordinary income. Determining the difference between the value of the stock and the price you pay gives you the gain, and you can determine how much of that gain you want to recognize in the current year. The same basic concept applies to employee stock purchase plans, or ESPP shares, since if you haven't held them for a long enough period of time to receive favorable tax treatment, you're making a decision as to whether you recognize ordinary income or not. This is true as well with restricted stock, though there's the potential for long-term capital gains treatment on restricted stock units as well as restricted stock itself. The bottom line is assess how much gain you'd like to recognize to fill up your buckets, your tax buckets in the current year. That's step 5. Step 6 is what to do after the fact. Let's imagine that our couple has recognized $80,000 of gain as we previously outlined. The tax withholding from their employer for these non-qualified stock options is going to be at supplemental rates. What that means is, for federal purposes, your company or the broker of the shares will withhold or hold back 22% of that gain and pay taxes with it. Now, that's all good and well if you're in the 22% bracket. The reality is people are anywhere between 0 and 37. So whether 22% is the right number for you is a big, big unknown. What if, for example, you as a couple are in the 35% bracket and they only withheld at 22%? That 13% under withholding means writing a big check come tax time, and no one likes surprises at tax time. Secondly, and just as importantly, we as taxpayers are required to withhold adequate tax during the year on income we receive, or we're subject to penalties. And so if insufficient tax withholding has taken place on your shares, you could be subject to penalties as a result. So it is important to understand which bracket you'll be in and if estimated tax payments are necessary to shore up that amount and avoid a big surprise as well as penalties come tax time. So there it is, 6 quick-ish steps on walking through the decision of recognizing gains in company stock at the end of the year. If you have any questions, please do not hesitate to email, call, or text me. I'm in this all the time, enjoy it, and would be happy to talk with you about your company stock. Thanks very much.